Owning a dividend stock can feel like the closest thing the market offers to free money. You buy the shares, you do nothing, and every few months cash just lands in your account. It looks like the company is paying you to sit still. Here's the uncomfortable part. At the exact moment that cash hits your account, you are not actually any richer than you were the day before. Understanding why is the difference between using dividends well and quietly fooling yourself. Start with what a dividend actually is. When a company earns a profit, it has a choice. It can pour that money back into the business, new factories, new hires, research, or it can hand some of it straight to the people who own the company, the shareholders. That direct payment is a dividend. Usually cash, usually paid every quarter, sized as a set amount per share. Own more shares, collect more cash. The companies that pay them tend to be the older, steadier, profitable kind, businesses whose fastest growth is behind them that would rather reward their owners than chase the next big expansion. Now the part the cheerful explanations skip. That cash does not appear from nowhere. It comes out of the company. The day a dividend is paid, the business is worth exactly that much less. The money literally left its bank account. And the market knows it. So on the day a stock goes ex-dividend, the cutoff date for qualifying, the share price drops by roughly the size of the dividend, right at the open. Picture a stock trading at $50 that pays a 50-cent dividend. On the ex-dividend morning, all else equal, it opens around $49.50. You got 50 cents in cash. Your shares are worth 50 cents less. Net change to your wealth that morning, about zero. In the real world, that drop is rarely exact because every other thing that moves a stock is moving it that same day. But on average, across thousands of these events, the price adjusts by close to the full dividend. There is no free lunch hiding in the timing, which kills a clever-sounding plan a lot of people try: buy the stock right before the dividend, grab the cash, sell right after. It does not work. You collect the dividend, but the price drop hands the loss straight back to you. And it is actually worse than a wash because that dividend is taxable. You would be paying tax for the privilege of moving your own money from one pocket to the other. So if the dividend is not free money, what is the point? The point was never the single payment, it is the stream. A dividend is a transfer of value today, but a healthy company refills that cash with next quarter's profits and the quarter after that. The thing worth owning was never the individual check. It is a business durable enough to keep writing those checks for years, and ideally to keep raising them. Some companies have paid and grown their dividend for decades, straight through recessions. That steadiness is also a signal. A company committing real cash to its shareholders every single quarter has less room to fake its health. The money actually has to be there. One last trap on the way out. Investors compare dividend stocks by yield, the annual dividend, as a percentage of the share price. A bigger number looks better. But a yield is a fraction, and a fraction can jump because the top went up or because the bottom fell out. A yield that suddenly looks enormous is often a stock the market is dumping because it expects the dividend to get cut. Chase the highest number blindly, and you can end up buying exactly the payout that is about to disappear. So no, nobody is paying you to sit still. A dividend is not money the market hands you on top of your investment. It is your own investment, handing you a piece of itself back in cash. The value was never in the check landing in your account. It is in owning something steady enough to keep writing them. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.